Hey everybody, welcome back. Today we're going to be answering some questions from Instagram and some comments we've been getting on several different social media platforms. It's been a while since we've done one of these Q&A videos, so let's get started. On a recent quote card that we posted to Instagram, which was talking about how there's a second wave of institutional capital coming into SFR.
Right.
Someone commented and asked what markets are they specifically targeting, or what are some top markets they're targeting?
Okay, good question. So yeah, institutions, big Wall Street backed firms wanting to buy homes. The places that they went 10 years ago when the first wave came through are still very popular. So rattle them off: Raleigh, Charlotte, Atlanta, Jacksonville, Tampa, Orlando, Dallas, Houston, Nashville, Phoenix, Vegas, Chicago, St. Louis.
Mm-hmm.
A lot of those places are pretty popular.
Mm-hmm.
They remain popular. What's changing is that because they got a little bit crowded, first-time buyers and investors competing for entry-level homes, some of those places in those cities I just named that were the outer ring suburbs that were a little bit further out of town have now become popular because the prices are lower, naturally. And the whole nature of commuting is changing now, right? There are people that are not having to go to work in the office at all anymore, or 1 day a week, 2 days a week. And so, it's a natural human instinct. And you go a little further out, you're like, I can get this for that amount of money. I can get a bigger parcel of land. I can get less congestion. And I only have to drive into the city 1 or 2 days a week, or I'm telecommuting, remote work, whatever you call it now. So that's part of it. But then there's a second round of cities that are getting attention also. And we can call them, I like the term late bloomer for both those outer ring suburbs, but also, if you like Charlotte, you're probably going to like Columbia, South Carolina. Right?
Right.
If you like Atlanta, there's a good chance you're going to like Augusta. Different core economics in terms of the employment base, but very similar migration economics of people just getting out of the Northeast and coming south. Atlanta is more crowded and more expensive, and Augusta is starting to catch people's attention. Down in Florida, I'm fascinated by the area between Orlando and Tampa, Lakeland, Winter Haven. If you draw like a circle around each of those metro areas, Tampa and Orlando, you see that they touch right in Lakeland, right? And so you've got an area there that is sort of that outer ring suburb to two different major metros in the state of Florida. Prices are low. It's nowhere near the coast. And so prices are fairly low, and those are attractive. I think Oklahoma City, Chattanooga, anything in Alabama, Mississippi is showing up. Ohio's always been pretty popular, but now, Ohio's an interesting state because there's like no really big city. Cleveland, I guess, is the closest thing, but it's got like 5 solid mid-sized cities, and it's populated from border to border in all directions pretty densely. So, Reno in Nevada, I'm seeing catch some interest. Why? Because Reno is not a very far drive from San Francisco. So you've got a very high tax state. In California, you've got a high density, super expensive area around San Francisco. You can drive, a handful of hours away. If you got to come back to the city to work 1 day a week or 2 days a week, you can do it. But Reno and that part of the state is gorgeous. People think of Reno, they think of seedy casinos, because when you see movies that feature Reno, they're always that. Mm-hmm. But that's not what that city is. It's a beautiful place. So Boise, Idaho is starting to show up on the list, right? So you've got investors that are looking in places that they didn't before, precisely because they're sort of untrampled by the institutional wave that happened 10 years ago. And I think that's good. I think spreading it out, I think there's, virtually every market in America has got something to love. Places that are beat up have got upside potentially. Places that are too expensive, they've got, bedrock demand in them, and then everything in between. So the more diversity of strategy that the investment funds and the small investor, the person who's probably watching this, small investor having a strategy that is sort of your own intuition. Where are people going? Why are they going there? Is that going to continue? Is it a good place? So much of it always comes back to lifestyle. The economics follow the lifestyle drivers. So everyday people who understand human beings can actually do some pretty sophisticated analysis of real estate markets just by being a good people watcher.
This one might not be as long. The post about the yield calculator, the simple yield calculator, someone just left a comment and asked, how is your closing cost so low? Usually Florida's seems to be extremely high, 6 to 12K. Thank you.
So that yield calculator is a formula. It's about internalizing the formula, all right? You've got rent, you've got a vacancy rate. You have to assume the place is not going to be occupied 100% of the time. You've got a cost, CapEx, capital expenditures to fix the place up to make it perfect. You've got closing costs. All those things come together to be your cost to buy, right? You got to put the real numbers in. So if the closing costs in Florida are $5,000, you need to put $5,000, and that's a national statement I'm making that you've got to apply local numbers to. And then the formula flows from there. You know, you've got your rents, and then you've got your expenses. The expenses are pretty straightforward, but you need to know what to put in. I put a national formula in for insurance. That's not the same formula for the coast of Florida where hurricanes come through, right? Your insurance is going to be higher. If you're in a flood zone, there's all kinds of factors that mean you've got to do your homework, but understanding, internalizing that formula is, I think, step one in terms of professionalizing your approach to investing in real estate. That's what I'm trying to do here, is to take what we've learned by working with the biggest, most sophisticated, most demanding investors in housing market history, and bringing that know-how and that technology and those techniques as best practices out to everybody else. Because I make my living with institutional investors, but I'm more passionate about regular, everyday people securing their future using this asset class. So I'm just trying to share the know-how.
Just for clarification, the low closing cost had a lot to do with the fact that institutional investors are paying cash.
Yeah, when you're paying cash, you don't have a mortgage. You don't have closing costs associated with that mortgage, right? That number was accurate on some transactions I did, but by all means, you know, talk to a local attorney or loan officer or real estate agent to figure out what the appropriate closing costs would be in the area that you're analyzing.